If you spend more than half the year in Thailand, you may be required to pay income tax on money you bring into the country. Let's take a deeper dive. I'm Dave Kendall. I'm a senior reporter and producer with the Bangkok Post, and I've been based in Thailand since 2005. On Deeper Dive, I take you beneath the surface of the big issues here in Thailand. Please share and follow this podcast, and you can watch the full video version on Spotify. If you stay more than 180 days in any calendar year in Thailand, you're considered a Thai tax resident. And since the beginning of 2024, any money you remit or bring into the country is assessable for income tax. But what counts as a remittance? Does it include ATM withdrawals and credit card purchases? Are certain income types, such as government pensions, exempt? If you have money saved overseas before 2024, can you transfer it tax-free now? Are remittances from joint accounts or family transfers taxable? How do double tax agreements work for expats living in Thailand? Can Thai authorities see your overseas bank accounts or investments? And do digital nomads on the Destination Thailand visa need to file Thai tax returns? Here to answer those questions and more, I'm joined by Carl Turner, co-founder of Expat Tax Thailand, and Sarawoot Intapanom, the firm's strategic government advisor. Carl and Kun Sarawoot, thanks so much for joining us here on Deeper Dive. If you're a foreigner in Thailand, what determines whether or not you need to pay tax?
Yep, it's a very good question, and thanks for allowing us to join. The tax residency is defined really as if you've remained in Thailand for 180 days or more in a calendar year. So calendar year is 1st of January to 31st of December. It's not consecutive, but it's throughout the year. So if you accumulate 180 days or more in a calendar year, then you're a Thai tax resident. If you're a Thai tax resident, it doesn't mean they have to file a tax return. It just means that they're a Thai tax resident, and there may be implications if they brought in income from overseas.
Okay, how about if you are in Thailand for less than 180 days, but you hold a long-term visa, such as a retirement visa? Are you also subject to tax?
Yeah, good question. So let's talk about the two ways that you have to pay tax in Thailand or file for tax in Thailand. So one is you've got local domestic income. So let's say you've got a rental property or you've got a salary in Thailand, for example. Then regardless of the amount of days, then you need to file that on a Thai tax return. So that's one scenario. The other scenario is if you stay in Thailand for 180 days or more and you bring in foreign source income. Now, this, Dave, is not tied to your visa. It's really tied to the amount of days that you're here. So whether you're on a retirement visa or LTR visa or permanent residence, for example, then you can have to file a Thai tax return depending on, one, if you've got domestic income, or two, if you stay in Thailand for 180 days or more in the calendar year and you remit foreign source income into Thailand.
Okay. And what kind of income is assessable? Is it any income that you bring into the country?
Yep. So there's defined lists. It might be better for one of our Thai accountants or Thai lawyers to discuss the revenue code specifically. But let's talk about Section 40 of the revenue code, which lists all of the income sources. So let's talk about if you stay here for 180 days or more and you remit this money into Thailand, then things like pension income, if you've got investment capital gains or dividends or interest overseas and you transfer that to Thailand, then that is income in Thailand. Or you've got a rental property overseas, you transfer that money into Thailand. This is all potentially assessable income.
The pension income is also assessable. People have to pay tax on that.
And not necessarily pay tax, so it's a bit more complicated than that. So basically, it depends on the income source. So let's first of all talk about what remittance is, because I think a lot of people are confused with that as well, Dave, if that's all right to explain. So we use remittance every day, but for most people, it's not a common word. So remit means you transfer to a Thai bank account, so either to your own bank account or someone else's. So if I sent the money, say in Thailand 180 days, and I transfer the money to your bank account, it's still my remittance. Okay. And then also, if I withdraw money from the ATM machine, that's remittance. And also, if I use a Visa or MasterCard, at the restaurant, or to pay for something in the shops, that's remittance as well. So that's the definition of remittance. And then, yeah, so that's the most important part is really understanding what remittance is. Then with the different types of income sources, let's specifically talk about pensions that you mentioned. It depends on if they remit the pension income into Thailand, yes, that has to be filed on a Thai tax return, but there's a few caveats on that. So there's something called double taxation agreements. So there's 61 signed between Thailand and other countries. And it really depends what it states on there about your pension source. So it's not on your nationality, Dave, it's actually on the pension jurisdiction. So where your pension is. Then we need to see, is it excluded or not? So for simple ones like US Social Security, which is a big one, that's excluded in the double taxation agreement between US and Thailand, that it's only taxable in the US. So for example, for that, that's not assessable income in Thailand. But for other pensions, let's say UK private pensions, for example, that's not excluded in the double taxation agreement. So for that pension, they'd have to file the income they remit into Thailand. And then with the double taxation agreement, it shows that they can use any tax paid in the UK as a tax credit against their tax in Thailand. So it's, David, for most people, it's an admin issue rather than a tax issue because if they've paid tax in another jurisdiction, usually, depending on the double taxation agreement, they can use tax credits. But there's some circumstances where there is quite a big difference in the tax, you see.
Actually, let me just ask you if you're sure that you don't owe any tax on your remittances, say that the only income you bring into Thailand is from US Social Security, do you need to file a return or can you just not bother?
Yeah, good question. So if it's exempt like US Social Security, um, you don't have a legal obligation to file that on the Thai tax return. But let's talk about how it looks from the Thai perspective. For example, any remittance into Thailand can be assessed, can be looked at what it is. If you don't file a tax return, and let's say all your income is tax exempt. The problem is, Dave, how do they know? How do the revenue department know or match up what you've remitted to what's exempt or not? So it's prudent in an ideal world to file a tax return for whatever you've remitted and then use the tax return to show that it is exempt under the DTA. So at least there's a record because Thailand's actually they've set up a new department for foreign remittance, hired over 700 staff for that department to focus on money that's remitted into Thailand to assess is this income or not. So you don't have to file for US Social Security, but it's prudent that you do because then the revenue can clearly show, you can clearly show that this is assessable income. But for other income, they, for example, that example about UK pension, or if it's it doesn't really matter, like a Dutch pension, for example. If you've paid the tax in the other country, that still has to be filed on a Thai tax return, but you have to claim the tax credit. So just because you paid tax in another jurisdiction doesn't mean you don't have to file, which is an important one that a lot of people don't really understand or they don't really consider.
It sounds like, I mean, it sounds like potentially hundreds of thousands of expats need to be filing tax returns and who are probably not doing so now. Is that fair to say?
Um, yeah, I think so. Yeah, I think uh, Sarah, it might be good to add in about the revenue department and what they've actually put in place and the information that they receive now.
Okay. So let me explain about this, Steph. There was an announcement in the late 2023. I believe that everyone maybe notices about this. So they published in the Royal Gazette. The Thai Revenue Department issued a departmental order called PO 161, which states that if you are a Thai tax resident, any foreign source income you remit into Thailand is accessible in the year it is remitted. So this showing a significant change from the previous interpretations based on a ruling from the 1980s, which allowed taxpayer to avoid Thai tax if the income was kept abroad for more than a complete year before being remitted. So the new rules tightens the remittance tax regimes, bringing it in the line with like what Carl mentioned before. It's about CSR requirements, and this is, I would say, to in line with the international standards.
Yeah, it might be good just to add about what the revenues, what data they've got. That's
So
quite interesting.
As I day by day speak with the revenue department to keep updating about information. So right now, all the information that even Thai or foreigners, all the money remitted into Thailand, all data sent to the revenue department. So day by day, they receive a lot of the list of the red flag that someone remitted a huge money. So because of the case that you have seen, like the laundry money, about the situations from the border, so it forces the revenue department to invest a huge budget to monitor these remittances from foreign source income. So many factors that making like the revenue department keep getting updatings or information about the money remitted from abroad. Yeah.
So this is in order to target money laundering. In terms of ordinary expats living here, how many audits are there? How likely is the revenue department to contact an individual expat and say, hey, what is this remittance for? And why haven't you filed a tax return?
Might be good for me to answer because
Yeah.
we file thousands of tax returns and we see people that come to us that have received letters in the post regarding there's a few different ways that can be contacted through the e-filing system, or actually via a letter, and then they can ask for the bank details and they want line by line what has been remitted and to prove the source of those funds as well. So we do see it, and it's becoming more and more regular now because the revenue department have actually invested quite heavily to integrate AI into finding patterns as well with bank accounts as well. So it's important. They can look back up to 5 years records, and if they think someone's been fraudulent, they can look back 10 years as well. So we do see that and have to support people with audits and not so much audits, but with investigations where they want to find exactly what's being remitted.
And in these circumstances where the revenue department contacts a taxpayer, are they going to apply penalties if tax has not been paid, or is it going to be, hey, you owe tax, please pay it?
Yeah, I mean, it's case by case. It depends whether it's whether they've actually it's a mistake or whether they've been fraudulently not filing. Most of the times, if they pay the tax, they'll just pay the late filing fees and 1.5% per month since it's been owed. That's the most cases that we see. So the revenue department are quite fair in terms of helping come to a resolution with that. But yes, they can add extra penalties on top.
You said that's 1.5% per month.
Right. Yeah. So if there's tax that's owed that's not being paid, then the revenue can charge the tax that's owed plus 1.5% per month since that tax has been owed. Yeah, correct.
And if that tax stretches back several years, that's going to add up.
It can. Yeah, yeah. So we've got a team of accountants that actually deal with back tax filing. So people that have realized or have not been compliant with, especially things like rental income that we've seen quite recently, or people that have remitted in large amounts or sold businesses and not dealt with it properly, that we've gone back and rectified previous years to get people up to speed because, yeah, the data that the revenue's got now is getting quite impressive. Yeah. Yeah.
Okay. Anything else that people should know right now about whether or not they owe tax?
I mean, it's important if people would like, they can book in free consultation, just go through their own situation just to see if it would be beneficial for them to look at backdating their tax. In most cases, it's easy to rectify, and usually it's better in most cases if they do that rather than waiting until they got contacted. It's not to scaremonger, it's just the actual rules that have been applied, and now the data that they receive is quite impressive, the Revenue Department, from other jurisdictions as well, with this common reporting standard. So there's over 120 countries that send the data direct to Thailand every year now. So bank account balances, interest that's overseas, they can view everything, and same the other way as well. So yeah, the information they receive is quite impressive, especially things like pensions, investments. Yeah, they can see that data from overseas. Yeah.
Now they can see the data presumably if Thailand asks for it. Is that correct? Or it's just automatically that data is just being shared around the world?
Yeah, good question. So with CRS, what actually happens if you put down your Thai tax ID number or you're a Thai tax resident, then the pension provider, bank, investment company, trust company automatically send that information to their local revenue department every year. And then that data is then shared from that revenue department to Thailand every year. So they send that data automatically in an XLS file once a year for all taxpayers.
If you've said that, if you've given your Thai tax ID number, is that correct?
Yeah, correct. And then from next year, CRS are trying to implement where they will share that automatically with other countries where they think that you may have tax residency as well. Yeah, so that's becoming yeah, a lot more intense in terms of the data sharing. Yeah.
How about people on a Destination Thailand visa, including, say, digital nomads who've got this 5-year visa? They've had to show in order to get the visa that they're making regular income from overseas employers or freelance assignments. Presumably, they owe tax on that money if they bring it into Thailand.
Yeah, yeah, good question. So again, it all depends on residence rather than their visa type. So whether they've got an O visa or PR or DTV, it's not really relevant about their visa type. It's to do with how many days were they in Thailand in the calendar year, and did they remit, so transfer, spend, withdraw from an ATM, foreign source income. So for DTV visa holders, it might be dividends or salary. Could be investment capital gains. We see that quite a lot, or rental income. If they spend that money in Thailand, then they need to file that on a Thai tax return, get a tax ID number and file that on a Thai tax return. Yeah.
Got it. Okay. Any final messages you have for expats confused about whether or not they owe tax?
I think the key is reach out. You know, people are here to help. The problem, if you look on ChatGPT or other LLMs, is it sometimes pulls out the data from the previous rules as well. So I really recommend reach out and we can answer any simple question for free. We have free consultations just so you can understand the rules. Also, we've got over 10 hours of videos online just for double taxation agreements. So there's a lot of content that we've got out there that people can understand for free, their own situation. And if they've got any specific questions, feel free to reach out. We're here to help.
Okay, great. The last major change was in late 2023, I guess. Are there any other changes to these tax rules that we can either look forward to or dread?
Yeah, so I mean, there's some potentially good news for expats. It might be good for Sarawoot to explain this. Can Sarawoot?
Yeah. Okay, thank you, Carl. Thank you, Carl. So on this, if everyone follow the Thai tax regulations and keep updated, you will heard about the draft of the new regulations. So like the new draft regulations proposing a new tax exemption. So just like what Carl mentions, this could be a good news for expats or Thai nationals like me. So all foreign source incomes is allowing a 2 year windows during which money brought into the countries could be remitted tax-free. However, for the current year 2025, this is we almost there already. So the existing rule is still applying. So the current regulation, which came into effect in January 2024, state that all foreign source income remitted by the Thai tax resident is subject to the Thai personal income tax. The proposed draft legislations aim to provide a tax exemptions for foreign income remitted into Thailand within the same years it is earned. However, this remains only a draft. It must be approved by the cabinet. And as everyone knows, like the prime minister has been removed by the court. And right now we have a temporary government. So we have to wait general elections expect early next year. In our opinions and consideration, this could be still changed. So I would suggest like this is very important to stay informed, keep up to date by reading the reliable news source like Bangkok Post and signing up for our tech alerts by email or subscribe our YouTube channel, expattaxthailand.com. So we keep updated everything from revenue department. All value information will alert to you immediately. So everything on time. So it's better just keep up to date. Everything could change right now.
Okay, so possibly there will be a new rule that says you're allowed to remit money that was, as long as it's the same year it was received in an overseas account. You're
Yes.
allowed to bring it in tax-free. That's just a proposal, and the earliest it could be passed into law presumably would be perhaps mid 2026.
That's right. Yes.
Okay, one final question. If somebody has a mixture of income of assets in an overseas account, so some of it may be inheritance, some of it may be rental income, some of it may be tax exempt pension. What determines which money was brought into Thailand?
Can I answer this, Dave?
Yeah.
So the key is it'd be better for our Thai accountants to explain this, but I can explain the principle. So what we do is we look at the account balance from before the rules change. So the 31st of December 2023. Let's assume that they've stayed in Thailand all this time. And that account balance can be remitted into Thailand anytime in the future. It's tax exempt due to the royal decree that was announced. The fact is, from that point onwards, any withdrawals from that account comes off that pre-2024 balance. So basically, whatever the balance was at that time, any withdrawals come off that balance, whether it was spent in Thailand or not. And then what we need to see is what's been added into there since then. So let's assume you've spent all that money since 2024. And now we need to see what have you been remitting into Thailand? Well, what we do is we look at the bank account and we look on a first in, first out basis. So we look at, was it the tax exempt pension that was paid in first? Was it inheritance? So when you've transferred the money to Thailand or spent the money in Thailand, we can actually log exactly what was spent and from where using first in, first out. So even though it seems that we get often many people say money's fungible, how do we know? There is a method to be able to work out exactly what you have remitted and what income source it is. So if people would like any help with that, yeah, we're happy to help. Once they understand the principle, it's quite easy to deal with.
But it does sound like having an accountant or a tax firm would help for the layman. Carl and Kun Sarawoot, thank you so much for joining us here on Deeper Dive.
Thank you.
Thank you. Thank you. Sawadee.
What are the takeaways? If you spend more than half the year in Thailand, you're a Thai tax resident, and you may owe income tax on money you bring into the country. ATM withdrawals, credit card purchases, and remittances to other people's accounts all count as bringing money into the country. Money earned prior to 2024 is not subject to income tax, but you may have to prove when it was earned using the first in, first out accounting principle. If you've already paid income tax to another country, you probably don't need to pay it again, but you may have to prove it. Some government pensions, such as US Social Security, are not subject to income tax. The Revenue Department is using AI to track overseas remittances into Thai bank accounts, so the chances of getting audited are rising. Penalties include a surcharge of 1.5% per month on the unpaid tax from the date it was due. In severe cases of fraud, you could face an additional fine of up to 100% of the tax owed. Under the previous government, there was a proposal to make any income earned during the current tax year exempt from income tax. But with the change in government, that proposal is on hold, and the earliest it might be passed is mid to late 2026. It's all a bit of a headache, but better to know now than be caught out later, right? That's it for today's show. Our email address is deeperdivethailand@gmail.com. Please like, follow, rate, and review this podcast. And as always, keep up with all the latest local and international news on bangkokpost.com. I'm Dave Kendall, and I'll see you again soon for another Deeper Dive.